Step on in, pull up a chair. History gets a little unfair. Stories, secrets, all scrubbed up. Welcome to the Dead Presidents Club.
Hey, welcome to another episode of the Dead Presidents Club podcast. I'm excited about this one. I'm excited about all of them. I know I always say that, but I'm especially excited about this one because this is the CPA to the stars. Is that true? I mean, it's about as true as it can be.
Complete false.
Oh, come on. You got Brad Pitt. You got Tony Robbins, I heard.
Yeah.
You know. No,
President Trump.
President
Obama.
Trump. Okay,
all
I'm glad you got both sides of this. I was a little nervous there for a minute. I got scared.
All of the presidents.
Amanda Hahn is, all joking aside, she is probably the most prolific expert on taxes and the CPA for just about everybody in the real estate space. And so I'm excited to hear more about your story and all of that. But tell us a little bit about your background. How did you get to where you are?
Well, my name is Amanda Hahn, and my company is called Keystone CPA. And I was actually a CPA first and real estate investor second. Growing up, my grandparents were real estate investors, and I lived in this condo apartment community where my grandparents were landlords, and they were very hands-on. So I basically grew up saying I never wanted to do real estate. I wanted to get a corporate job, work at a desk in an office. So I became an accountant. And surprisingly, I ended up in the real estate group, and that's sort of where I got exposure to the power of real estate and what it could do in terms of wealth building and tax savings.
And so do you invest in real estate a lot yourself now?
Yeah, I do. And that was actually what prompted me to start our firm, to help other people understand the power of tax savings using real estate, because my first job was at one of the big four law firms, and there we worked with very high net worth individuals who understood tax strategies. They had their CPAs all the time. But when we started investing ourselves and we started going to real estate meetups, that was the first time we realized that not everybody knows that there are tax strategies, and that most people sort of just pay their taxes because that's all they knew how to do. So
that blows that. I mean, so my background's banking. I grew up in banking, and I jokingly say maybe you can we can co-author it, but I want to write a book called "I Can't Believe That's Legal." Like literally, when I got into the game, I could not believe it's largely all tax related too. I'm like, how is this? How do people not go to prison for this?
Yeah.
Like I spent my whole life. I was a high income earner, W-2. I've spent millions of dollars in taxes and had no idea that I could legally never do that again. And I don't think I've paid federal income taxes in 4 or 5 years, and legally. Disclaimer, because people like you are the gateway to this knowledge that the average consumer who's still very intelligent still doesn't understand very basic concepts that could change their financial life.
Yeah, it was funny. I was just joking with Brandon Turner about how we first started working together, and he actually sent me his tax return that he filed in TurboTax. And he said, Amanda, I owe a lot of taxes. Can you take a look to see if I missed anything, or maybe it is what it is? And that was such a strong statement, because a lot of people think their tax bills it is what it is. It's just something that happens to me every year. I hate it. I'll complain about it, and then it will sort of happen again next year. The more money I make, the more taxes I pay, right? But I mean, I feel like the fact that real estate is a way to save on taxes, it's not a secret. Everybody knows about it. Everyone knows that's why wealthy people own real estate. But nonetheless, people still think that's only for very wealthy people. It's for the Elon Musks of the world and not for somebody like me. You know?
Well, let's talk about that for the layman average, person that might be listening to this. Like, what's one or two very basic things that I always say this: if your CPA is filing your taxes and not talking to you about it, they work for the IRS, not for you, right? Like that's I know that's the joke in the industry, but that's the truth. What are some a couple of just basic examples that people don't think about that they could use?
Well, I mean, as real estate investors, I think one of the most commonly missed opportunities is write-offs. A lot of people tend to think for some reason that you can only write things off if you have a legal entity. And for a lot of new investors, you probably are spending money on your real estate activities before you even own real estate. For example, you join masterminds, you go to conferences, buy books and learn about real estate. And all those things are tax deductible against your real estate income, regardless of whether you have a legal entity or not. And so when you start investing in real estate, it's important to understand that you are now a business owner in the eyes of the IRS. And by business, we mean the business of investing and not the business of an LLC or a corporation. And I would say, because you mentioned you were a high income earner, what's really important to understand is that the way the US tax system works is the higher income you make, the higher tax rate you're paying. So especially if you're someone with high income, tax savings could be very significant. You know, if you're writing off a $1,000 trip, that could be saving you up to $500 in taxes just in that one thing.
Right. So good. On the more maybe deeper level, but still simple for most investors. I raise a lot of capital. I raise a lot of private money. We have a fund. We do different things. I'd say the majority of my investors now are investing through their self-directed IRAs. Talk to me about like that strategy as a play. What are you seeing? Like, obviously very common in your world. Like, what? Give us a kind of synopsis. First of all, what is a self-directed IRA?
Yeah.
How does that help you as both the IRA owner, but also for me or somebody that's listening as an investor raising capital?
Yeah. I mean, it's really an amazing way to really build wealth. What Wall Street doesn't really tell us, that's why not many people know about it, is that your retirement money, IRAs, Roth IRAs, 401ks, they don't have to be stuck in the stock market. You know, we're not limited to index funds, mutual funds, and those kinds of stuff. You can actually invest in all kinds of different things. For example, startup businesses or a rental property or note investment. And that's been around forever, but nobody talks about it because Wall Street doesn't want us to know. CPAs don't talk about it because they don't understand it. Not very many CPAs understand it. And your financial advisor definitely doesn't talk about it because that's taking money away from how they make money, right? They make money when your 401k invests in the stock market. And so, but for a lot of our clients, because real estate is their niche, that's their asset class, it just makes sense to put your retirement money in real estate, which is an asset that you know very well and have more control over. And within real estate, of course, the term real estate is generic, right? We could be doing flips, we could be doing rentals. Note investment is one of my favorites in a retirement account for two reasons. One, when we lend money, we're a note investor, what we earn is interest income. Interest income is typically taxed at your highest marginal rate. So because if I'm paying taxes at my highest rate, I'd prefer to have that in a retirement account where I'm not paying taxes today or maybe ever, right, if it's in a Roth. And the second reason I love note investments in a retirement account is when I invest in notes, I don't really have a lot of write-offs because I'm passive, right? And you have all the write-offs. Yeah. I don't get depreciation because I don't own the property. I just hold this note. And so for that reason, I like it in a retirement account because it's already protected from taxes or it's tax deferred.
Yeah, I love that. Here's one I'll give you. So I'm a self-proclaimed solo CPA. I
love it.
I'm very safe.
Don't trust this guy. Okay.
No, I'm a ChatGPT CPA. So even worse. So I want to play a game of agree or disagree because this is how I view it. But you're the expert. All right. So when I think about self-directed IRAs, one of the main things, because you can do all sorts of things. You said LLCs, cryptocurrency, precious metal. You know all these hard assets. What I have seen a lot of people get in trouble with is they go, oh, well, I'm going to use my self-directed IRA money to go invest and buy a rental property myself or do these things. And then they go use their IRA as a down payment or they buy a fix and flip and they get all sorts of like trouble because there's limitations that the IRS puts in place. My opinion, this is the agree or disagree, is it is far better to use your self-directed IRA money to do one of two things when it comes to real estate. Either invest in other people's deals or invest in deals that you can pay fully in cash. Agree. Could you talk about why that would be? Or I'm happy to if you don't know where I'm leading you.
I mean, other people's deals are great, right? One of the rules of using your retirement money in self-directed investing is that you can't be actively involved. And so like you were saying, if I bought a fix and flip or I bought a rental property, I may be enticed to go and start swinging a hammer, or I may want to have my kids stay in there if it's like, property by the beach. And so investing in other people's deals like a syndication or a fund really by design prohibits me from doing those things. So that's what I love about that. With respect to buying a property all cash, I mean, real estate investors, we all love leverage. So I know it's very difficult for people to hear. If you're going to use leverage, what I always say is at least have reserves in the account to pay for unexpected things. Because if I only had $200,000 in my IRA and I used all of it on the acquisition, well, how am I going to pay the bill if I don't have a tenant in there, right? Because like you said, there are limitations in how much I can fund a retirement account.
Well, and this is where I get out of my depth. So you also start to reduce the benefit of the IRA with leverage entirely because of UDFI tax. So can you talk a little bit about UDFI and because I think what most people get confused by it, they go, well, I'm going to go use my IRA, put 20% down on a property and get financing. Well, you can do that, but then you're only getting tax advantages for 20% of the value of the property. Is that right?
Yeah, exactly. So the IRS allows you to use leverage in a retirement account, which is what you described, 20% down, and then the rest will be bank money helping me to grow my asset. And UDFI basically is a tax associated where the IRS says, okay, well, if this property, let's say the property is 50% leveraged, then if it made $100, then we say, well, $50 was from your IRA, which is tax deferred. The other 50 is from leverage, which the IRA has to pay a tax associated. And this one surprises, I would say, a lot of investors because no one talks about that.
Right.
And also a lot of CPAs don't even know that that's a thing. So there's a lot of compliance issues that we see when we work with clients. Sometimes is we're the first person that ever told them about UDFI. There is a way around it though. If you're someone who invests through a solo 401k, for example, then you basically bypass the UDFI and then you're able to use leverage.
Yeah. And as I understand it too, and this is probably a little bit too in the weeds, but for the sake of the people that are doing this, as I understand it too, if you can pay the property off for 12 months,
a year ahead, yeah.
A year ahead, you're exempt from UDFI as well.
Exactly, because the leverage portion is in looking at the average of the outstanding debt of the previous 12 months.
Right.
So there's a lot of flexibility, and we know that most real estate deals are leveraged, especially if you are investing in syndications and funds and things like that. So really important to make sure you talk to your CPA and you're planning ahead so you're not caught off guard upon the exit of that deal to say, oh my goodness, I'm losing 37% plus to this tax I've never heard of.
Yeah, and potentially penalties and taxation because you violated a rule you didn't know you were violating.
And what a lot of people don't know too is that the UDFI tax actually applies to Roth accounts too.
I didn't know
People
that.
think that, if I invest in a Roth, it's tax-free. Well, you're right, it's free from income taxes.
Wow. But
the UDFI is a totally different tax. But I will say if you're, we're talking about it from the investor's perspective, but for those of you who are raising money, right? Raising private money, raising money through syndications, or even in your first deal, if you don't have money, but you have friends or family members who have money, a retirement account is a really great place for you to look for funding because most people don't need that money to live off of. And so it's always a situation where if you give them good returns, that's probably money you can recycle into your next deal and the next deal and the next deal.
And that's exactly why I always tell people the best thing to do with retirement. First of all, retirement capital is the best money to raise because people are not needing it tomorrow, right?
We call it patient money. Very patient.
Yeah, I love that. And so we raise a lot of money that way. But when we're educating the investor, because a lot of them want equity, they want these things. Well, if you're investing with me, you're potentially liable for this UDFI tax, and it's eliminating the tax benefit of your account altogether, or largely. And so I think that it's better to use my post-tax money as my cash money for my deals and to use my IRA money for other people's deals. That's how I teach it, and it sounds like you agree.
Yeah, and it's also investor specific too because everyone has a different profile, right? So, for example, if you wanted to do note investing and some deal where you have equity, then usually the note, much better in a retirement account for all the reasons we talked about. If you're investing as an equity ownership and you can use the depreciation benefits, maybe that is what you use cash, or you're accessing equity from your home or another rental to get into those deals.
One last question, and this may be too gray of an area for a public forum, but I'm going to ask you anyways. And we'll watch the CPA at work here. We'll see how she answers. I've heard this advice given before. Why not just trade IRA money? So I've got an self-directed, you've got an self-directed. I'll invest in your deal, you invest in my deal, but now it's free and clear.
Yeah. So what you're talking about is the prohibited transaction where I can't invest in my own deal, you can't invest in your own existing deal, so let's swap and trade. You can do that all the time as you wish. The potential issue is is there a agreement that says this is contingent? So I will invest in your deal contingent upon you investing the same dollar amount in my deal. And if there is such a record of that, then the IRS could collapse it in what they call the step transaction. Step transaction meaning, well, I can't invest in my deal, so I have basically invested in your deal, and then that money cycles back to my deal. So ultimately, it was still me investing in my deal. So we've had clients utilize something similar. But the key to doing that is to make sure that those two transactions are as unrelated as possible, right? So different time frames, different dollar amounts. It's really two different things instead of I'm just basically giving you money to give back to me.
I want to say this, Amanda, that was the best answer I've heard on the issue. You know, oftentimes CPAs, attorneys, when you enter into some of these gray area transactions, they don't want to define it. And I think that that's a brilliant definition to go, hey, if it's contingent, it's reciprocal by definition, and they can collapse that transaction. Yeah. But if it's a legitimate trade of different types of deals for different purposes, then it works. I love that. That's great. Well, let's pivot for just a second and let's talk about depreciation for a minute, because it's a big real estate topic. Can you break down depreciation? Because depreciation in real estate in specific can be confusing for people, because it's like, wait, aren't these things appreciating?
Yeah.
And yet, meanwhile, we're losing all our money, right? Did I lose all my money last year? I don't know what happened, Amanda.
Yeah, exactly. So depreciation is basically just part of the tax code. The tax code says, if you own a hard asset of any kind, a machinery, for example, the asset itself will deteriorate over time. And that's the same for a real estate building, right? So when you buy rental properties, the IRS says, okay, well, there's a building here, and over time, there's going to be wear and tear. As a result, then we allow you to take depreciation write-off. So basically, it's what we call a paper loss. A paper loss, something we're writing off by law, irrespective of, in reality, whether the property is appreciating or remaining the same or going down in value.
Okay. So as a real estate investor, I get some specific advantages for depreciation, right? I can use, as a real estate professional, I get to use my depreciation against all forms of income, right? I've got a construction company, I've got a plumbing company, I've got a property management company, and I get to use all of my paper losses to offset that income. But if I worked at a W-2 and I was still at Bank of America, I wouldn't get that luxury, right? I'd only be able to use that depreciation against passive forms of income. But there is a workaround to that, right? Talk to me about what that is.
I mean, there's a couple different workarounds. So one is, so if you're someone who's working full-time at a W-2 job, then if you have a spouse who's not working full-time, right, maybe a stay-at-home, then if your spouse qualifies as a real estate professional, then you can use the losses, depreciation, write-offs, you can utilize that against W-2 income. Sort of what we call the marriage tax loophole, right? Only one person has to qualify, both people will get the tax benefit.
Love it.
This works really well for a lot of our clients who, you have kind of the breadwinner in the house, somebody else who doesn't have to work full-time and loves to do real estate, right? Or at least we brainwash them to love real estate. So that's one specific workaround. Another one is the short-term rental tax loophole. And so that is where if you invest in Airbnb properties, then you don't have to be a real estate professional. You could potentially use your short-term rental tax losses that are generated from depreciation and things like that. Those could be used to offset W-2 and other income as long as you meet material participation. So in both scenarios, material participation basically means you're involved in the day-to-day operations of your rental properties. The significant difference between regular rentals and short-term rentals is in regular rentals, and that includes, commercial, mobile home parks, everything that's not short-term, basically. For a real estate professional, to meet that status, you have to have more time in real estate than your job, which, like you said, if you worked full-time at B of A, almost impossible to do.
Right.
Versus in the short-term rental loophole, we don't care how many hours you work at your job. So it works really well for people who work full-time or dual-income household, both working full-time, and real estate investing is a side hustle, right? Because we don't care about job hours.
Yeah, so hypothetically, if I make $100,000 a year, just for simple math, and I go buy a $500,000 Airbnb, short-term rental. According to, we don't need to get into all the logistics of this, but if I do a cost seg and bonus depreciation and all these things, I could probably get close to $100,000 in depreciation on that $500,000 property.
Yeah, you probably get more.
Get more. And so then I can write that off against my $100,000 W-2 job and essentially pay 0 taxes.
Yeah, exactly. And we have a lot of clients who utilize the strategy because, it's a way for high income earners to achieve the same results as someone who does real estate full time, but without actually doing it full time. And the material participation, usually the status is to get at least 500 hours on your short-term rentals, but depending on when during the year you buy, for example, if you purchase a rental in the third or fourth quarter, sometimes you can utilize that strategy with as few as 100 hours of short-term rental time. But keep in mind, there's another rule that you also have to follow, which is that nobody else has more time than you.
Right.
So example might be, I bought an Airbnb in October, put it into service. I have 130 hours. The cleaning crew only had 40. The landscapers had 20. Then I'm able to use that tax strategy effectively.
What about like recapture? So say I'm a W-2 person. I put this thing into service in November, December. I get my STR loophole. I write it off. Next year goes around. It's just not working for me. And I want to switch to midterm or long-term rental. Do I have to recapture that?
Nope, you certainly don't. So the way it works is every year stands on its own. So if in that first year it's a short-term rental, you meet the hours, as long as you've extracted all of the tax benefits you were looking for, that's all we care about, right? And then the next year, theoretically, if you're doing things right, we might have taxable income because we took all the deduction in the beginning and now it's stable, it's cash flowing. And year 2, maybe we care less, right? If, I'm meeting the hours or not. Maybe I want it to be passive income instead.
Wow, that's phenomenal. Well, Amanda, you're obviously a genius, at least a tax genius. I'm sure a genius and much more. Tell us 2 things before we wrap. First, what's some just practical wisdom that you would just leave? It can be tax related, it can be just for life. What's like one or 2 pieces of advice you'd give somebody that just wants to start doing money different?
I feel like the biggest mistake that people make is waiting too long to work on their finances. And I'll talk about taxes specifically because, taxes is something that happens to all of us. It happens every single year until death, right? That's nothing is certain except, death and taxes. And the common mistake people make is thinking, well, I'm not ready for tax planning yet. Those are people with, how many properties do I have to own? How many doors should I own before I do tax planning? How much income should I be making before I do tax planning? And in reality, tax planning has nothing to do with either one of those questions. Tax planning is most powerful for someone looking to build wealth. I want my money working for me in investments. That is someone who will benefit from tax planning. Because if you think about it, that's what the tax code incentivizes us to do. Right. Invest, create jobs, right? And so if you're doing those types of things, you could be making less than $100,000. Tax planning could make sense. Yeah. Or you could be someone making $1 million a year, and if your goal is to spend all of it on personal things, then you shouldn't do tax planning because there is no incentive for just spending money on yourself.
So when should I hire Keystone?
Yesterday.
No,
I'm just kidding.
I love it. I'd love it. No, like if I'm the average listener, like at what point do I go, I need Amanda, I don't need TurboTax?
Oh, yeah, that's a difficult one for TurboTax, because TurboTax is only, the output is only as good as the person doing the input. And I feel like, again, you don't want tax strategies to take you away from doing the deal. I also come across this a lot too. People spend all their money on legal advice and accounting advice, and then that actually stops them from doing the actual deal. But I would say if you're serious about investing, even if we're talking about your first deal, the sooner you can afford planning around tax and legal structure, the better it is, because oftentimes when you set things up incorrectly, it is very expensive to unwind, sometimes impossible to unwind.
Yeah, and I have been guilty of that in my businesses. It's been very expensive. I would have been Brandon bringing you a TurboTax return saying, help. And the sooner you can get ahead of that, the better. But I will tell you this, I have saved more money in taxes than I've ever spent in tax strategy. And that's, I think, what you guys excel in. Well, Amanda, appreciate you jumping on and giving us a ton of just like deep practical wisdom. How do people connect with you? How do we, how do people sign up for or sign up for a consult, find out if Keystone's right for them?
Yeah, my company is called Keystone CPA, and so you can go to KeystoneCPA.com. We have a free tax risk assessment. because over 40% of tax returns we review from other firms are not optimized for tax savings.
Wow.
So we put together a quick little analysis that you can take online yourself. When you're done, you'll get emailed your score. And two things. One, if you score high, great. You're ahead of most investors we meet. But if you score low, what I always tell people is then utilize that as a tool, right? When you meet with your CPA, the next time you can print it out and say, hey, here are the places that I scored low on. Can we start the conversation there on what are the opportunities within each of those segments? If you're looking for daily tax tip, probably best place to find me is on Instagram as Amanda Han CPA.
Amanda Hahn, CPA. Well, Amanda, thank you once again. I know you're so busy. You're probably one of the most sought after people here. So the fact that we got a little bit of time with you means a lot to me, and I appreciate that. I hope you guys enjoyed this episode. Please check out Keystone, check out Amanda, and get ahead of it. Because I tell you from personal experience, the longer you let it wait, the more painful it becomes. And so we want to get ahead of this as quickly as we can. But hope you enjoyed the episode. We'll see you on the next one.